Okay, hello everyone. I hope I am audible. Daria, can you hear me?
Yes, Neil, can hear you.
Fantastic. So we'll give it 5 more minutes and then we'll start. Just some ground rules before we begin. So Prakash will be presenting in the first 20-25 minutes or so. Then we'll open it up for questions. You can type your questions in the comments even as he is speaking, and we will take them in the first come, first serve basis. Um, so you don't forget your question right at the end. You can type it right away. Um, so yeah, as I said, we will begin in 5 minutes. Thank you. Prakash, in the meantime, can we just test your audio again?
Yes, Neil, am I audible?
Yes, you are. And perhaps you can just test the screen share one more time.
Yes.
Yes, fantastic. We can see the screen also. Are you able to change the slides, Prakash?
No. Not able to change.
Okay,
So
I think so. Have you shared your entire screen or is it
Yes.
just the network?
Let me try once again.
folks, we will begin in just a few minutes. Some of you have raised your hand. So the system for questions is that you can type them in the comments while Prakash is presenting. The presentation will be about 20-25 minutes. And then you can, essentially, he will answer the questions that you put in the comments. So once we're done with that, we might invite you to come and speak and ask the question in person. But I would prefer it, at least initially, if you put them in the comments. So Prakash, if you click on share window, it should work. That's what I normally do.
Yes. Is it fine now?
Yeah, we can see it. Try changing the slide once. Yes. Yes. Perfect. Perfect. We are good to go. All right. So as many of you would have often read Prakash in the Mint over many years. I think this is one of the rare occasions when we've got some time for him to come and speak, and we are much obliged to him for it. And tax filing season is right upon us. Deadline is looming heavy. Um, so even if you have filed your returns, this is a good way to check if you've made any mistakes, if it has to be revised. If you have not filed it, great way to check how you should be filing, which form, what all you have to include, etc. So without further ado, Prakash, over to you.
Hi, good evening, everybody. Thanks, Neil and team, for this opportunity. As Neil mentioned, for the next 20-25 minutes, let us discuss the contents of the slide. After that, let us take the questions.
Yes, please proceed, Prakash.
Yeah. Here we have a brief agenda for the discussion. Who has to file ITR? Which ITR form to be filed? When should it be filed? Which tax regime one has to choose? And some other information. Let us start with who has to file the income tax return. Every individual, whether he qualifies to be a resident or a non-resident, has to file the tax return if the gross total income exceeds the basic exemption limit. What is the gross total income for this purpose? Let us have a look at that. The gross total income includes salary, business income, income from house property, other sources like bank interest, dividend, etc., capital gains. But before the deductions, which are listed below, are deducted. Exemptions from capital gains, deductions for investments, other deductions, etc. So before reducing these amounts, if your gross total income is exceeding the basic exemption limit, then you have to file the income tax return. Your total income may be much below the basic exemption, but when we consider the gross total income, many times it would be higher. So the requirement for filing of the income tax return may arise. What is the basic exemption limit for the financial year 24-25? Let us have a look. Under the old tax regime, for regular individuals up to the age of 60 years, it is 2.5 lakh. For somebody who is resident senior citizen, that is between the age of 60 years and 80 years, it's 3 lakh. And more than 80 years, we call them as super senior citizens. The basic exemption limit is 5 lakh. But under the new tax regime, it's uniform for everybody. The basic exemption limit is 3 lakh per year. Even when the gross total income is below the basic exemption limit, there may be a requirement for filing of the income tax return. Let us have a look at what are those situations. If you have deposited rupees 50 lakh or more in your savings bank account, or if you have deposited 1 crore plus in current account, or you have spent 2 lakh rupees or more on foreign travel, or if you have paid 1 lakh rupees or more in electricity bills for the whole year, or if you are in business and business turnover is more than 60 lakh rupees, or if you are in profession and your gross receipts from profession is more than 10 lakh, or if TDS or TCS for the whole year is 25,000 rupees or more, this amount would be 50,000 or more for senior citizens. So in all these cases, even if your total income is below the basic exemption limit, you are required to file the income tax return. Also, there are certain special aspects where the resident Indians have to file the tax return. Let us see what are those. Even if your income is zero, but if you hold any foreign assets, say for example, if you have some property in a foreign country, or if you have a foreign bank account, or if you are a beneficiary of any foreign asset, you need to necessarily file the income tax return and you have to disclose all the details in the FI schedule. For non-residents of India, let us see whether they need to file the tax returns. They need not have to file the income tax return if the income is nil or is solely from dividends from Indian companies or interest from Indian government securities or corporate deposits or debentures or long-term capital gains if tax has been correctly deducted at source. The same basic exemption is equally applicable even for non-residents. And even if the income which are listed here and where the tax has been deducted and the income is more than the basic exemption limit, they need not have to file the income tax return. Even when it is not mandatory, is it a good idea to file the income tax return? Here we have the answer. Definitely, filing the income tax return, even when it is not compulsory, helps you. It can help you to claim the refunds if there are any TDS amount or TCS amount, or if there are any losses that has to be carried forward. Unless you file the income tax returns, that is not possible. Also, in many situations, for getting the loans or for getting the visas or subsidies, as a proof of income tax return can help you. Many times, there may be transactions which may be recorded in the income tax department's portal or the financial institutions, where the notices from the income tax department may come in future if the income tax return is not filed. In the past, we have seen many non-residents receiving notices from the income tax department, even when the exempt interest, that's NRI interest, has been received, but the income tax return has not been filed. So there may be property transactions which have been done by the non-resident, but because it resulted in a loss, they might not have filed the income tax return. Even in such situations, the income tax department has sent notices to those non-residents. So it's a better idea to file the income tax return even when it is not compulsory. The next question is, which ITR form has to be used by an individual? Let us see. There are 4 types of income tax return forms: ITR-1, ITR-2, ITR-3 and ITR-4. Each one of them would be applicable in a specific situation. When ITR-1 has to be filed, you cannot use ITR-2 or you cannot use ITR-3. You need to necessarily stick to the specific ITR form. If you use the ITR form which is not specific to your case, which is not applicable to your case, there is a risk that your income tax return may be treated as invalid. Let us see when ITR-1 is applicable. The resident individuals who have income equal to or less than 50 lakh rupees from salary or pension, or from only one house property, or income from other sources where there is no lottery income or no income from race horses, or where long-term capital gain from equity or equity mutual fund is less than 1,25,000, and where agriculture income is 5,000 or less, then ITR-1 would be applicable. In simple terms, I can say resident individuals who have income below 50 lakh would be generally eligible for filing of ITR-1. Who are not eligible for filing ITR-1? If you have income from business or profession, or income from more than one house property, or if you hold any unlisted shares or foreign assets, or if you have foreign income, or if you are a director in a company, resident but not ordinarily resident or non-resident, or if you have capital gains beyond 1.25 lakh, or if you have deferred ESOP tax, or if you are claiming foreign tax credit, ITR-1 does not suit you. Let us now see when ITR-2 would be suitable. Here, when an individual has income from salary or pension or house property or capital gains, other sources, this form is applicable. Of course, there are other criteria as well. If somebody is holding unlisted equity shares, or if he has foreign income or foreign assets, or if he is qualifying to be resident but not ordinarily resident or a non-resident, or if that individual has agricultural income more than 5,000 rupees for the whole year, or if he's a director in a company, or if he has deferred ESOP tax, or any bank has deducted tax under section 194N for cash withdrawals, or brought forward loss is there, or carried forward loss is there, or spouses or child's income has to be clubbed, then ITR-2 would be applicable. In the case of ITR-1, the income limit is 50 lakh. Here in ITR-2, there is no income limit, whatever be the income, if other conditions are fulfilled, you can file this. But if you have income from business or profession, ITR-2 cannot be filed. Next one, ITR-3. Who can file ITR-3? Individuals or HUFs who have income from business and profession, or hold unlisted equity shares as investments, or if you have income from house property, salary or pension, other sources, or a partner in a firm. These people are eligible for filing ITR-3. Who are not eligible? Companies are not eligible. Business or charitable trusts, partnership firms, association of persons or body of individuals are not eligible for filing ITR-3. ITR-3 has to be used when you cannot use ITR-1, ITR-2 or ITR-4. The last type of income tax return form which is applicable for individuals is ITR-4. When is this applicable? Let us see. If the individual is a resident, or HUF is a resident, or even a firm which is a resident, and if that individual or firm or HUF has business or professional income which is taxable under presumptive taxation under section 44AD or 44ADA or 44AE, or income from salaries there, or pension plus one house property, or income from other sources, then also ITR-4 is applicable. But the conditions are long-term capital gain from equity or equity mutual fund should be 1.25 lakh or less than that. And again, total income should not exceed 50 lakh. Professions with gross receipts up to 50 lakh also can use this form. Who are not eligible for filing ITR-4? If that individual or firm has income from more than one house property, or there is some foreign asset, or if that person is having signing authority in foreign accounts, or there is some foreign income, or he is a director in a company, or he holds unlisted equity shares investments, or non-resident, resident but not ordinary resident, or if there is brought forward loss or carried forward loss, or ESOP tax deferred. In these cases, ITR-4 cannot be used. Here we have summarized in a table the same thing whatever we discussed. Perhaps later, if you get a copy of the PPT, this might be useful for you. Neil, you think we need to discuss any points here?
No, I think most people will fall in the individual category. So everyone's aware of 15th September. I think we can move to the next.
Yeah. When ITR has to be filed, here we need to keep in mind that the usual deadline is July 31st, but only for this financial year, 24-25, 15th September has been the deadline. But in case you are a partner in a firm which is getting audited, or if you run a business or profession which is subject to audit, only then October 31st is the deadline. Also, you should keep in mind of the deadline for filing of the revised income tax return. Suppose you file your income tax return by 15th September and you realize that you have done some error or omission while filing the income tax return. Then you have an option to file the revised income tax return by correcting that error or omission. For this, you should file the revised income tax return by 31st December. And for all practical purposes and legal purposes, revised return is replaced in the original income tax return which you have filed earlier. Common reason to file revised returns are omission or incorrect information. Say it could be due to any missed income or wrong deduction or incorrect exemptions, or change in taxable income, or you might have, if you have used incorrect ITR form, then also you can revise the income tax return, or it may be to reduce or enhance the refund amount. The deadline is 31st December each year. In case you miss the deadline of September 15th, which is the due date for this year, what happens? Still, you have an option to file the belated income tax return up to 31st December. But here, in the case of belated tax returns, there are certain consequences which we will discuss in the next slides. What happens in the case of a belated tax return? That's the user, if you cross the usual deadline of 31st July, in this, particularly this year, September 15th, what happens if you cross that deadline, but you file before 31st December? Then there will be a late filing penalty, which will be 1,000 rupees if your total income is equal to or below 5 lakh rupees, or if your total income is more than 5 lakh, you have to pay a late filing penalty of 5,000 rupees. There will also be interest under section 234A and 234B. If any taxes are payable because of the delay, this interest could be payable. Also, if you have any business loss or say capital loss, it cannot be carried forward since you are filing it as a belated income tax return. Assume somebody has missed filing the belated income tax return by 31st December also. Then that individual has the option of filing updated income tax return, but it comes with a high cost because the government will levy additional taxes on the tax liability. I'll briefly explain what exactly updated income tax return is. This is applicable for somebody who has missed the original income tax return or revised return or belated return, or if you want to correct some error or omission in the previously filed income tax return, or if you want to correct the head of income or tax rate, etc. An individual is restricted from filing the updated income tax return if the total tax liability is fully offset by TDS or TCS and there is no additional tax payable. In other words, if you have to file the updated ITR, there should be payment of additional tax. To claim the income tax refund or to claim the nil or loss return, you cannot file the updated income tax return. The updated income tax return can be filed only once for any particular year. And also, updated income tax return cannot be filed if the income tax department has already issued a notice for assessment or reassessment, or if the assessment is completed. After the updated income tax return is filed, it is treated as a regular return for processing and assessment. Let us quickly look into the deadline for filing this updated income tax return. For the financial year 24-25, updated income tax return can be filed up to 2030. That is almost a window of 4 years plus 3 months have been given for this. For the earlier years, say for financial year 23-24, deadline for updated return is March 2029. Similarly, for 22-23 financial year, deadline is 28 March. For financial year 2021-22, deadline for filing of the updated income tax return is 31st March 2027. What is the additional cost for filing the updated income tax return? As I told you, updated income tax return can be filed only if you have to pay additional tax. You cannot file it to claim any refund. On this additional tax payable, you have to pay 25% of the tax and interest as an extra payment to the government in case you file the updated income tax return within 12 months from the end of the assessment year. So for financial year 24-25, assessment year is 2025-26. In case you file the updated income tax return for assessment year 25-26 within 12 months, 25% of the tax and interest is additionally payable. Similarly, if there is a delay and you file the updated income tax return anytime between 12 to 24 months from the end of the assessment year, then 50% of the tax and interest would be additionally payable. For year 3, that is 24 to 36 months of delay, 60% of the tax and interest is payable, and any updated ITR filed between 36 months and 48 months from the end of the assessment year, 70% of the tax and interest would be payable. So you have the option to file the updated income tax return for the next 4 years from the end of the assessment year. But as the years pass, the cost of compliance will be very high. For the financial year 2024-25, we have the tax slabs here under the old tax regime. In the next slide, I have the tax rates for the new tax regime. Only thing I want to add here is, of course, all of you are aware of these tax slabs. I don't have much to discuss here. Where the total income exceeds 50 lakh and it is below 1 crore, 10% surcharge would be payable. And if the total income exceeds 1 crore, if it is up to 2 crore, surcharge rate on tax would be 15%. If the total income exceeds 2 crore but less than 5 crore, surcharge rate on tax will be 25%. And if the total income exceeds 5 crore, surcharge rate would be 37% under the old tax regime. Under the new tax regime for financial year 24-25, the tax slabs are also slightly beneficial. And here you need to see the surcharge rate. Again, 50 lakh to 1 crore surcharge rate is 10% of the tax, and 1 crore to 2 lakh, 15% of the surcharge. Above 2 crore, it is 25% of the tax. So here you don't have one more surcharge rate of 37%, which is there in the old tax regime. So for individuals who have total income exceeding 5 crore, surcharge rate under the new regime will remain at 25%, whereas in the old regime, it becomes 37% of the tax. The next question is, which regime has to be chosen by an individual? It depends on the facts and circumstances of each case. We can just have a quick look at what are the benefits you get if you go for the old regime versus the new tax regime. If in the table you can see old tax regime benefits and new tax regime. See, rebate under section 87A in the case of old tax regime is limited to 12,500, whereas in the new tax regime, 25,000, which means in the old tax regime, if your total income is 5 lakh or less, because of this rebate coming into play, you will not pay a single rupee as tax. But in the new tax regime, if your total income is 7 lakh rupees or less, because of rebate, which is allowed up to 25,000, you will not pay a single rupee as tax. Standard deduction for salary under old tax regime is 50,000, new tax regime is 75,000. Effective tax-free salary income for an individual because of this is, in case of old tax regime, 5.5 lakh, in case of new tax regime, 7.5 lakh.
Sorry, Prakash, just one clarification. So this table applies to the previous financial year. So in this financial year, it's 12 and 12.5 if you have salary.
That is for financial year 25-26, this limit has gone up. What I'm explaining here is for financial year 24-25, for which we need to file the income tax return.
Yes, please proceed.
Yeah. In the old tax regime, HRA exemption, leave travel allowance, food allowance, standard deduction, all these are available. In the new tax regime, only standard deduction would be available. In the old tax regime, entertainment allowance, deduction for profession tax, all that are available. You can see in the table. In this slide, you can see interest on home loan under section 24B is available both under old tax regime and new tax regime. Then employer's contribution to NPS as a deduction is available both under old tax regime and new tax regime. The other items appearing here are available only in old tax regime. In the new tax regime, there are very limited exemptions and deductions. We have listed quite a lot here. I want to refer to some deductions which are available in both regimes. See here, all contribution to Agniveer Corpus Fund, it's available in both the regimes. Deduction on family pension also similarly, gifts up to 50,000 available in both regimes. Exemption on voluntary retirement or exemption on gratuity, exemption on leave encashment, transport allowance for specially abled person, all these are available even under the new tax regime. Just an overview, old tax regime versus new tax regime. Tax rates in the old tax regime are higher. whereas in the new tax regime, they are lower. Deductions and exemptions in old tax regime are many, new tax regime very limited. Complexity in old tax regime is high, new tax regime is obviously low. Old tax regime is suitable for investors and salaried with many deductions. New tax regime is ideally suitable for taxpayers preferring simplicity. Here we have an example of somebody who is earning a salary of 20 lakh rupees. Assume he has made investment on section 80C up to 1 lakh rupees and medical insurance premium is 30,000. Interest paid on home loan for self-occupied properties 2 lakh and political party donation is 75,000. Let us have a look at how the calculations appear under the new tax regime and old tax regime. Because of the various deductions and exemptions under the old tax regime, his taxable income will be 17 lakh 50,000. Under the new tax regime, it will be 19 lakh 25,000. But what is interesting is total tax payable under the new tax regime will be much lesser because of the lower tax rates. It comes to 2.78 lakh, whereas in the old tax regime, it is as high as 3.51 lakh. Some other information in addition to this tax returns, forms, etc., let us discuss. In case somebody has traveled abroad for a longer term, there could be a possibility of double taxation. Many countries have double taxation avoidance with India. The double taxation avoidance agreement helps an individual to reduce the double taxation. In many situations, an individual may qualify to be a resident of India as well as a resident of a foreign country. For example, he may qualify to be a resident of USA. In such cases, India will also tax his salary or any other income for the whole year, and US will also tax for the whole year. What happens then? This is the situation what we call as dual residency. This situation has been discussed and explained in double taxation avoidance agreement. Applying certain criteria, we need to tie-break an individual to one of the countries, and that country will give relief to that individual by giving a credit for the taxes paid in the other country. So there is some mechanism to avoid the impact of dual residency. Also, under the double taxation avoidance agreements, for non-residents of India who are receiving income from India, in certain specific treaties, there are lower rates of taxation for interest, dividend, or capital gains, etc. It again depends on the country with which India has the double taxation avoidance agreement. Also, under the double taxation avoidance agreement, there are certain exemptions for taxation of salary for non-residents who are not in India, but if the salary is paid in India, for example. In case of residents of India who are paying taxes abroad, the foreign tax credit for the doubly taxed income can be claimed in India, which will help that individual to reduce the impact of double taxation. But such foreign tax credit has to be claimed by filing Form 67 at the time of or before filing of the income tax return in India. Some other very important information which has to be filled in the ITR forms, which I suggest you should not miss. The first thing is on the filling up of FA schedule, foreign asset schedule in the ITR form for residents. Say if an individual has some overseas bank accounts or assets, etc., in the FA schedule, all the details which are listed there have to be properly filled up. Similarly, filling up AL schedule, that's assets and liability schedule, if the total income is exceeding 1 crore is very important. I have seen in our practice, many of the individuals miss to report this and end up in quite a lot of difficulties. Very recently, we had a situation where one of the gentlemen from Tamil Nadu approached us. What he had done was in financial year 16, 17, 17, 18, 18, 19, for 3 years, he had filed the income tax returns in India. He had received certain stock options from a foreign country and it was not reported in the income tax return. Very recently, as late as in 2025 February, the income tax authorities issued notices to him seeking information on the income and the details of assets in foreign. And when we dug further, we understood that he had stock options which are not reported in the income tax return in India. Unfortunately, that individual was not aware and it was not reported in the FA schedule. Accordingly, an explanation was given that all the income has been declared, but only the details have not been reported in the income tax return. The income tax officer was not happy, and under the Black Money Act, he levied a penalty of 10 lakh per year for 3 years. We suggested that the individual should go in appeal before the commissioner. Even before the commissioner, he has lost the case. Now we are in the process of filing the appeal before the Income Tax Appellate Tribunal. This is just because of sheer ignorance, not intentional, but still the law requires an individual to report each and every foreign assets details without fail. And also, we have another case where an individual has filled up AL schedule as per her, what I can say, whims, without getting into the exact details. Say in the financial year 21-22, she had filled up the AL schedule with assets totaling to, for example, 1.5 crore. In the following year, suddenly she has filled up the market value of all the assets what she is holding as 5 crore, whereas her income was hardly 1 crore. The income tax department took the matter for assessment to analyze how the value or the cost of the assets could have increased from 1.5 crore to 5 crore in 1 year. That's approximately an increase of 3.5 crore, whereas her total income itself is 1 crore. Unfortunately, that lady did not receive the mails which were sent to her for assessment, and she missed to respond. The income tax department has considered that 3.5 crore as unexplained money, and they have levied a tax, penalty, interest, etc. The total amount is close to 4.5 crore. Now we are in appeal before the commissioner. So be careful with what information you fill up. Filling up these details is not a formality. You have to be very, very cautious. The last point I want to mention here is, in case you want to choose the regime, which regime has to be chosen? You have to see the total amount of exemptions and deductions available if you go for the old tax regime, then calculate the tax versus the new tax regime. For somebody who has total income exceeding 15 lakh, if the total amount of deductions and exemptions is 4,33,000, then the new tax regime makes sense. If the total exemptions or deductions is more than 4,33,000, then only old tax regime could be helpful. Just a brief note on what is Form 26AS. We have explained here. It has the details of the tax deduction and tax collection. It captures all the data. While filing the income tax return, make sure that you go through each of the line items in 26AS, and also each TDS has been properly reported, and claim that TDS or TCS in your income tax return and get the deduction applicable. In case somebody has deducted the TDS and it is not appearing in 26AS, you need to reach out to that person, bank, or it could be any other organization, and ensure that they report it properly. It should reflect in 26AS. AIS and TIS are nothing but the summary of the financial transactions as appearing in the income tax portal. They show what are all the financial transactions done by you. It could be, say, investments in fixed deposits, or the interest you have earned on savings bank account, or it could be interest from fixed deposit, or it would be purchase of a property, sale of a property, investment in mutual funds, or redemption of mutual funds, sale of shares. All these get reported in AIS and TIS. While filing the income tax return, please go through each of the row items and make sure that they belong to you and they are properly reported in your income tax return. What will happen if there is some information or some item which are appearing there, they do not belong to you? You need to log into the portal, and there is an option to give feedback against each of the row items, and you should tell that these do not belong to you or these are incorrect. You need to give the feedback and make sure that AIS gets updated to reflect the correct transactions. For the purpose of ITR filing, some of the documents that are necessary are PAN, Aadhaar, Form 16, AIS, bank statements, etc. Additionally, depending on the nature of the income what you have, you need to make sure that you maintain all the documents in a file or a folder, so that in case of any assessment in future, any inquiry in future by the income tax department, you are able to produce all this. You should not scramble around at that time. Please make sure that you maintain each and every document which has the financial transactions details. What are the do's before filing your ITR? We have just summarized few of them. Choose the correct ITR form. If you miss to choose the correct ITR form, there is a likelihood that the form may get rejected or it may become invalid. Verify your income tax return after e-filing. Many of the individuals file the income tax return but forget to verify within 30 days. Verification process had to be completed 120 days long ago, but from last year they have reduced it to 30 days only. Within 30 days, please verify, otherwise your income tax return becomes invalid. All sources of income have to be reported. Say if you have some exempt income, please make sure that is also properly reported, though it may not have any impact on the taxable income or the tax amount. For the purpose of ensuring the information is proper, you need to report them also. It could be, say, PPF interest, or earlier dividend was exempt, or it could be any other exempt income like gifts, etc. All that, it's ideal to report. Also, you need to make sure the declaration what you give in the income tax return about your residential status is correct. Whether you qualify to be resident, not ordinarily resident, or non-resident, you have to properly mention there. Timely payment of taxes, payment of advance tax during the year itself can help you to reduce the interest liability. As I mentioned, you need to be organized, collect all the necessary documents, and maintain them. What you should not do at the time of filing of your income tax return: do not forget to claim eligible deductions and exemptions. Don't report only taxable income, report even exempt income. Don't wait until the last minute to file the income tax return. Don't confuse between financial year or previous year with assessment year. Financial year / previous year refers to the year in which you have earned the income. The return what we are going to file now is for the previous year 24-25. We also call it as financial year 24-25. Whereas the assessment year is 2025-26. Assessment year is the year in which you file the income tax return for the earlier year. From next year onwards, this confusion is going away. With the new Income Tax Act coming into play from 2026, there is a uniform word what they have used, no confusion. They simply call it as tax year. That can help many people like us. Yes, Neil.
Thank you so much, Prakash. We've got a lot of questions in the comments, and we'll try to take as many of them as we can. We might extend this session a little bit so that we can accommodate a few more questions than the time normally would permit. So very quickly, Darya, do you want to go in order that they were asked?
Yeah, so I'll go in the order. So first question is from Poonam. The question is, I wanted to know if a company pays gratuity at a time of living along with ex gratia, does the ex gratia gets taxed at full slab? And above what amount is gratuity taxed?
The exemption for gratuity is dependent on the computation. It's governed by the provisions of gratuity, payment of gratuity act. If the individual is leaving the organization after a period of 5 years, then only the gratuity amount will be exempt, and the ex gratia payment is taxed at the applicable tax rate, that's the slab rate. The maximum amount of gratuity exemption is limited to 20 lakh during the whole lifespan of the individual.
So next question is, I have more than 500 lines in equity mutual fund sales, and the cost reported in many lines are not correct. In some cases, there are no cost mentioned, which is showing a huge capital gain. How to handle this?
Yeah, as I just mentioned, in the AIS, you have the option to give the feedback. If something does not belong to you, you need to go there and choose the right drop down and inform the concerned authorities that the information appearing there is incorrect. That information goes back to the concerned mutual fund. They have to respond to that, whether it's correct or not. And if it is incorrect, obviously they will say incorrect, and your AIS will get updated.
Yeah, so next question is from Akshay. I have a small income of rupees 150 in intraday trading. Do I still have to fill ITR-3 or can I show the amount in income from other sources and file ITR-2? There won't be change in any in the text.
I agree, but the principle is intraday trading is treated as income from business, and when you have income from business, you have to go for ITR-3, even though it's slightly lengthy. You have no choice. Please don't put the amount in income from other sources. Of course, it will not affect the tax amount, but procedurally it will be incorrect. You should not use the incorrect form.
So next question is anonymous. ESOPs not listed in India for dividends received, tax paid outside India. IT department classify this income as income from other sources and issue tax notices. Even if submitted form 67 and there is DTAA in place, the department not considered a DTAA is tax to be paid again in India.
Now, assume the tax rate in the foreign country is 20%, and assume the tax rate in India on the dividend is 30% because of the slab rate. You will be eligible for foreign tax credit of 20% only, which would be the lower amount. On the differential 10%, you have to pay the taxes. In case, even after submission of Form 67, along with the proof of payment of the foreign tax, the CPC or the tax authorities have not given the eligible amount of tax credit, you should try for rectification. If that doesn't work, then you need to necessarily go in appeal.
So next question is from Sarabjit. I have short-term capital gain loss in previous year, financial year 22-23, and hence used ITR-2 to 5 return. Now to carry forward that loss, not offsetting it against any capital gains in financial year 23-24, which ITR form should I use?
You have to continue to use ITR-2 only, because ITR-1 will not allow you to bring forward the loss.
Interesting. So next question is anonymous. My company gave me some Amazon vouchers worth around 4,000. I have added those to perquisite and considering them an income from salary. But what the company has done, they have shown in 23K in other perquisite and 19 in deduction. What should I do? I have left the company.
The question is not clear.
I'll come again.
Yeah.
So my company gave some Amazon vouchers worth 4,000 rupees. I think so it will be around 40,000. I have added those to perquisite and considering them an income from salary. But what the company has done is they have shown 23,000 in other perquisite and 19,000 in deduction. What should I do? I have left the company. Okay, so balance, they have shown 23 in perquisite and 19 in deduction, and he has received only 4,000.
Then he has to reach out to the company and ensure that it is rectified.
Yeah, so the problem is he has left the company.
Still, he can reach out to the HR. There will be a common mail ID. This happens with many of the employees, and always, even I have seen employees going back to the previous employer after 5 years also for clarifications. The companies oblige.
Okay. If LIC policy matures in particular year, then how should I show the maturity amount in income tax returns?
First thing is you need to see whether that maturity amount is exempt, because there are certain conditions for qualifying exemption. If it is exempt, then you have to show it in the EI schedule. If it is not exempt, then it may go under the head income from other sources or capital gains, depending on the kind of life insurance policy.
Okay. So this is anonymous. My father sold 2 properties, one on profit and another on loss. Will the capital gain will be net off after taking the loss? Which ITR form to complete and what documentary proof may be required?
If your father does not have income from business or profession, then he has to necessarily choose ITR-2. In ITR-2, if both the properties are long-term assets, then netting off is possible. If one of the properties is long-term, the other one is short-term, then you need to see, because if there is a long-term loss, then it can be set off only against long-term gain. Subject to that, you can set off.
So yes, Suresh, we will be sharing the presentation. The next question is, I have a mutual fund and shares portfolio, but not sold a single share this year or redempted. Do I need to provide any information while filing income tax return?
In case your total income is exceeding 1 crore, then in the AL schedule, you need to mention the cost of the investments in shares and securities in the applicable column as of 31st March 2025. Otherwise, there is no requirement. In case somebody holds the unlisted shares, then also the details have to be given in the unlisted shares column in the ITR form.
So there is this question, confusion regarding whether the total income, including capital gains, being less than 7 lakhs, qualify for the new tax regime. Initially, a nil tax at the time of filing as per portal for last financial year, but a notice was later issued requiring tax payment without granting relief under section 87A.
Yeah, that matter has been quite disputed. The recent order of the Income Tax Appellate Tribunal has allowed the 87A rebate in such situations, but the income tax authorities in the CPC are not allowing that. If you want to contest that, you need to go in appeal.
So next question is from Dhaval. Hello, sir. Can mutual fund equity long-term capital gain be exempted from tax payment if I am using the seal proceeds for buying a residential house?
Yes, it is possible under section 54F, subject to the conditions mentioned in 54F. One of the important conditions is you should not hold more than one house property at the time of sale of the shares. There are other conditions on the time limit, etc. It's possible.
Yeah. So next question is, 2 years ago, I got a salary from a company for 3 months. Then I was outside India as non-resident. Do earnings in the past year, no earnings in the past year, do I still need to file ITR?
In the slide deck, I have discussed that already.
Yeah. So next question is, if I sold shares in a financial year, I have to file ITR2, and if I just own shares and haven't had any capital gains, I file ITR1.
Right. If those shares are listed shares, ITR1 would be good enough. But if they're unlisted shares, or if the total income is more than 50 lakh, ITR1 won't be helpful.
Yeah. So next question is, my daughter has gone abroad for higher studies and used to file tax returns. Now, how to determine whether she should be classified as a resident or non-resident for tax purpose?
The determination of residential status is dependent on the physical presence of the individual. If the daughter has gone for higher studies, then for that particular financial year, you need to check whether she has been in India for 60 days or more. Then the criteria for the earlier 7 years should also be checked. But for the intermediate years, unless she comes to India for more than 182 days, she will not qualify to be non-resident. The exercise has to be done based on the stay details for each of the years.
Yeah. So next question is, what is AIS? We have answered that. Followed question is how it can be accessed and how it is used for tax return.
In the income tax portal, if you go to the login page, at the top itself, you can see the AIS tab. If you click that, you will be able to get the AIS for the last 3 or 4 years.
So next question is from Kausal Raman Natrajan. TDS shown on 26 AIS, 26 AS form for home rental income is shown as 2% of rent, whereas the TDS rate was 5% till 30th September and 2% only after 1st October. How is this to be corrected?
The 2% rate is applicable for anybody who has deducted in March. But if somebody has deducted before September, then 5% was the rate applicable. I'm not clear. Perhaps if the TDS amount is appearing in 26 years fully, then he can very well claim that as TDS in his income tax return to adjust against the tax liability or has to claim the refund.
Yeah. So if my daughter, an Indian resident paying income tax, move to US for further studies, can she in next financial year file return as NRE?
NRI, non-resident of India, she can file the income tax return.
Is it possible to adjust the amount paid for an appeal that was not pursued when filing the return for next financial year? if the payment was made in the same financial year?
While filing the appeal, you have to mention the assessment year for which the appeal fee is paid, and also the head under which you pay the appeal fee is different. It cannot be adjusted against the tax liability.
Okay. Does basic exemption limit still is valid if there is a capital gain from selling a property?
Yeah, basic exemption limit is still valid, but if that individual is qualifying as a non-resident for the capital gains, basic exemption limit is not applicable.
The question is now, can we switch from new tax regime to old and vice versa?
For somebody who does not have income from business or profession, it can be done n number of times. Anytime she can do that. But for a person who has income from business or profession, it can be done twice only. That means one switching out and again switching in. That's the end.
So next question is, which ITR form is applicable for someone who has salary income and income from Amazon affiliate commission?
I hope Amazon affiliate commission is coming from an Indian company, and it is a business. I guess it's a business income. If so, then ITR-3 would be applicable.
So by claiming HRA, the place of work is asked instead of place of residence. However, residence is a metro and working remotely. How to claim HRA with place of residence?
Yeah, this is a new confusion which has come up. Ideally, you have to show the place of residence itself there. Otherwise, you won't be eligible for the correct amount of HRA exemption. This has started from only this year.
So I booked the under construction house in September 24 for making payments towards the property. I sold my other property in December 24. How should I take care of this when filing ITR, considering new owner deducted TDS, paid to the tax authority, and money was reinvested towards payment for new apartment?
So if I have understood properly, under construction property was sold in September 2024.
Was booked in 24 September.
Okay.
The old property was sold in December 24.
Yeah.
And the question is, how should I take care of this while filing ITR, considering new owner deducted TDS, paid to tax authority, and money was reinvested towards payment for new apartment?
Yeah, the exemption is very well available under section 54. In the capital gains section, he has to show the details of the property sold and also the date of investment in the new property. He will be eligible for the deduction under section 54.
Yeah. So next question is there a limit to when an appeal goes to commissioner instead of just reaching the JCIT?
Yeah, usually the limit is where the tax liability is less than 10 lakh, it's going to JCIT. Where it is more than that, it's going to Commissioner Appeals as per the details which were shared by the Income Tax Department earlier.
Yeah. So next question is from Raghu. For how many years back income tax team can come up old assessment for scrutiny and ask for details?
Generally, they can go back up to 5 years and 3 months if the individual has income from Indian sources. If it is from abroad, they can go back for whatever time they want. That means usually what happens is if the tax authorities identify some bank account or some assets in a foreign country which might have been earned or which might have been invested, say 20 years ago, but if they identify now, that will be treated as current year's income and they can levy the tax. That is what the law is.
So next question is, there are multiple details or multiple entries in AIS. Should we provide feedback? Additionally, there is no option for free writing. It only allows selecting specific items from drop-down menu. What should we do?
Yes, you have to choose the best possible drop-down. That is one of the challenges. In many cases, we are seeing that because whatever we want to write, it's not allowed. We have to choose what is given there by way of drop-down. In many cases, we may have to give an incorrect answer, but let us give the nearest answer possible.
Yeah. So next question is from Ishwar. My mother is 100% disabled, so can I claim under 80DD?
Yes, possible.
Next question is again from Ishwar. My company provides accommodation in which I reside, but my family resides on rent. So can I claim HRA benefit?
HRA benefit cannot be claimed. HRA exemption can be claimed only when the employee is staying in that property. Otherwise, it's not possible. Since he already has a company leased accommodation, it is not possible.
Yeah. So next question is, my grandmother passed away in August last year. How do I file the ITR?
You have to get the registered will if she has something, or there are certain set of documents, including, say, the legal aid certificate or probate, etc., that has to be uploaded in the income tax portal using her login, and the legal aid's login, and it has to be approved by the income tax authorities. Through that, it's possible to file the income tax return.
So next question is it possible to adjust the amount paid for an appeal that was not, this is repeated.
Yeah.
Next question is Tushar. I was in Singapore from 2006 until 2014, and then I returned to India. However, I still hold an account in Singapore, which has some funds. Which ITR form should I use?
You should use ITR-2, and you should give the details in the FA schedule.
Okay. So there is this question on Schedule EL, assets and liabilities. Do I need to show the cost of acquisition or current market value?
It should be cost of acquisition.
Next question is, my wife is doing coaching classes online, just 2 hours a day, not an employee. Per classes, they are providing rupees 250. The coaching entity pays monthly without any TDS. Which ITR to be used?
She has to go for the income from business or profession, that is ITR-3, because has to be treated as income from profession.
So next question is, I'm a salaried person and get income from YouTube advertisers from India. Can I file ITR-4?
Sorry, I couldn't get.
I am a salaried person and get income from YouTube as well as advertisers from India. Can I file ITR-4?
ITR-4 is possible if the total gross receipt is below 50 lakh.
Okay, so next question is, if I am employed, should I still show some PF interest getting approved in ITR form? If I'm not redeeming it, is it getting, it's just getting accumulated?
If the annual PF contribution done in the earlier years by the employee is less than 2,50,000, then the interest earned by him is exempt. But if the annual contribution has been more than 2.5 lakh, the PF authorities maintain a separate account for interest accumulation on the excess amount, and they deduct the TDS on such excess and report it in 26 AS. In case the amount has not been reported in 26 AS, the individual need not have to declare the accrued PF interest.
Sorry, Prakash, I think the question is about accrued PF interest after the person leaves employment.
In case the individual has been there with the employment for 5 years or more, the interest is exempt. But if the period of employment is less than 5 years, that interest is taxable and should be offered to tax.
Prakash, are you sure this is after? So the person leaves employment and the interest is, the balance is just left there in the PF account. It's earning interest. So that becomes taxable, right?
Yes, that becomes taxable.
So it should be declared every year or only at the time of withdrawal?
It has to be declared every year, ideally. Again, since it comes under that income from other sources, you can either go for the mercantile system of accounting or the cash system of accounting. Where mercantile system of accounting is followed, you need to declare on an annual basis. Where cash system is followed, you have to declare on receipt. It depends on what system has been followed for all kinds of interest. Generally, what I have seen is all the individuals follow the cash system of accounting. That's as and when the interest is received, that's declared. It's up to the concerned individual based on the system what has been followed.
Okay, thank you.
Yeah. Next question is, my father and mother both are 100% disabled. So can I claim 80DD for both?
Yes, subject to the limits given there, and also it should be supported by the expense receipts.
I haven't declared yearly dividend and non-guaranteed corpus from my endowment plan for 3 years. How can I correct it?
Sorry?
I haven't declared yearly dividend and non-guaranteed coupons from my endowment plan for 3 years. How can I correct it?
I assume that it is taxable, otherwise this question would not have come. If it is taxable, the option now is to go for filing the updated income tax return, declaring that income and paying the tax plus additional tax amount. But first, you need to identify whether those amounts are taxable.
Yeah. So I think so. We have last 3 questions.
Yeah, maybe last 2 questions and we should close.
Yeah, I think so. We just have last 3, so we can take that also.
Okay.
Can I receive a refund for amount paid for an appeal? Achha, this is so repetitive.
Yeah.
PF trust deducted TDS on PF interest for amount not transferred to new employee due to KYC issue. Do we still need to pay tax on slab rates even if we eventually transfer the PF amount to current account after resolving KYC issues?
Theoretically, it is not taxable. But practically, what happens is in Form 26 AS, this is reflected as income. And if the same is not offered to tax in the income tax return, there is a possibility the CPC may issue a defect notice. If it is possible, I would suggest him or her approaching the PF authorities and getting it rectified, so that 26 AS reflects the proper amount, or it may not reflect the amount here, since it would be exempt.
So the last question is, I get freelance income from overseas along with my salary. Which ITR form to file?
If it's freelance income, then it will be income from profession. ITR-3 would be ideal.
Yeah, so this is it.
All right, Prakash, thank you so much. Bit of a marathon for you, but really obliged. I think you helped a lot of people at this crucial time. So thank you very much.
Thanks, Neil. Thanks to all of you. Thanks.
And we will send you Prakash's presentation within a day or 2.
Yeah.
Thanks a lot.
Thank you, Prakash. Thank you, Neil.